In today's Mind the Chat, I have the pleasure to have with me Ingo Rameshol. Ingo is an old friend and is managing director of Bosch Venture Capital. Hi, Ingo.
Hi, Alberto. How are you?
Pretty good, pretty good. Despite the challenging times, I think everything is shaping up good. What about you?
Thanks. Good, very good.
Let's talk immediately about the COVID situation, as is changing the life of global corporate venture capital. What's your, again, the first experience after this month? How do you see that?
Yeah, when we went into the first wave and partially lockdown in March, April this year, a lot of things changed, especially for companies who were just fundraising during that time. That was difficult because investors were not able to visit companies, and suddenly the process was in most of the time postponed. It took a while until we really catched up. And we got used on the new situation, and then it was quickly visible that we found a new way of approaching startups, of discussing startups, also financing rounds with startups. And I would say in summertime, situation was stabilized. Yeah, most of the companies had funding again, and you know that still there's a lot of money in the venture industry. There are a lot of funds which have still a lot of money in their portfolios. Yeah, and we got used on the new way of deal sourcing, of looking for deals. A lot of virtual events started, and we suddenly have driven our overall portfolio online. Relatively seldom that we meet companies directly. But then we have also seen the chances of the crisis. So many companies in our portfolio deal in the topic or in the area of digitalization, data processes, working on large data, in combination with the trend that people are working more remotely, software is moving into the cloud. Yeah, and suddenly most of our companies have seen larger order income due to that specific change. And that's naturally, if you are betting on companies which might disrupt existing industries, and then an external disruption like the Corona crisis happens, something is moving. And this is what we are currently observing. So most of the times in positive direction, but yeah, you never know, the crisis is not over. Might be a second, third wave. Yeah,
I think we are a bit more equipped now to deal with that. And then also, if you look at the data, they are pretty difficult to be read. Again, a number of deals decrease, but the amount of financing is almost stable compared to the same period last year. And so on the one hand, there might be that, well, at least what I see, but I like also to get your opinion, is that later stage company, the funding is not particularly affected, also because they're companies that have prior investors on board, and then if they need, they got a refill. I think the Corona probably impacted mostly the early stage segment. So company that was looking for first-time funding, and then doing this totally online might be a bit more challenging. What's your take here?
Yeah, so exactly, we have the same observation. Overall, I guess on a worldwide basis, we have about 10+% less number of deals. but the same amount of money. Even in Q3, it was a little bit more than last year. So it's a clear signal that later stage deals get more money. Funds are feeding their portfolio companies first, and usually these are more later stage companies. On the other side, we also do see less seed deals. It's true, and I think it will come back. It's a temporary thing, but that's the actual.
Oh, surely will come back. The problem, what we have lost in between. I'm pretty sure that as we readjusted to this new way of doing, and I think probably not having things, we will get some benefits also from this month. We have a lot of learning how to do things differently. I think also the system will adjust also to deal with early stage. But probably that is the part that still we haven't found a solution, because one thing is to refund, follow up with an investment with someone that is in your portfolio that you know you already bet in the past. Other thing is to start a totally new relationship. Despite we see also, talking more on the procurement side, we see many of our customers that are starting collaboration with startup that never physically met. And that's positive.
Yeah, absolutely. Especially in the open innovation space, we got quickly used on a new situation. That a physical meeting is not mandatory anymore, which accelerates some of the international business, certainly. If a meeting is not possible, then you do it without. You save money, you can come more quickly into business. So this is a chance for sure. If you have to give a deep introduction of your technology or your devices or software, then it's a bit of challenging. But I think it's also a chance to get quicker in business by accepting that online is the new reality. Yeah, why not? So
I think it's time to adjust. Perfect. So let's go back to our original scheduling that was to discuss Robert Bosch and specifically Robert Bosch Venture Capital. Just to get started, first of all, congratulations are in order. Robert Bosch made it again in the Corporate Startup Stars, and this year has been recognized at the #2 in the global Corporate Startup Star ranking. So congratulations to you.
Thank you very much,
the Robert Bosch team.
Thank you very much. It's a great honor to be there.
And you also got awarded for your investment activity as Robert Bosch Venture Capital. So again, a lot of double congratulations. And specifically, I think it would be good to get an introduction. Again, Robert Bosch is pretty well known, but giving just the overall context of Robert Bosch and specifically, which is the overall organization of Robert Bosch talking about innovation.
Yeah, so we have founded the venture unit already 13 years ago. I'm with the unit since a little bit more than 5 years. And from the very beginning, we had the innovation in mind. So the very first idea was there is some form of innovation outside. So maybe this is a tool to access this innovation. And this is basically still today the key idea and our mission to access the growing number of external innovation. And this is not only growing by the sheer number of startups worldwide, but also by the funding we do see worldwide into the startup scene. So it's unavoidable that innovation coming from venture financed companies is more and more playing a key role because these companies are getting more and more money. So innovation is following also a little bit the money. And we are doing this twofold. So on the one hand, we certainly are acting as a venture fund. Yeah, you can see us as an institutional venture fund, investing into companies, exiting companies, and making money with this investment activity. This is no secret that we are very strongly also return focused. On the other hand, to enable Bosch to be an or to stay as an innovation leader in their segments today, we have to have the access to the best companies. And if you are not a good investor, a good venture investor with good returns, you probably are not able to get good deals and good deal flow. And this is a precondition for us. It's just an enabler. Yeah. So money making is an enabler for innovation making. That's the key idea. And it's a little bit over our funds. It's a little bit more changed into the operational standardization of getting innovation from startups into our corporate company. Yeah, we call this Open Bosch, and Open Bosch means nothing else than matchmaking, standardized matchmaking of innovation or innovative companies with the relevant units in Bosch. Yeah, and there we are following the venture client model, and this is scaling up now. Yeah, so the venture unit is still an absolutely important part of the game. Otherwise, you do not get the relevant deals, and you are having difficulties to access or to assess the good deals from the bad ones. Yeah, there are many companies out there. So who is the best one? Yeah, I mean, you need some network and also some venture experience to assess these companies, and that's the way we're doing.
So I think you gave us a lot of food for thoughts in just I was trying to write down a couple of the points that you made. I think is very, very valuable, and I don't want to lose them. I wanted to do a sort of deep dive on a couple of them. First of all, talking about, again, Robert Bosch have venture capital units, Robert Bosch Venture Capital. Yes, probably is one of the oldest in Europe, and if I'm not wrong, is a structure as a closed fund, and I think you are currently at fund number 4. So meaning there's been 4 different investment cycle, pretty large, if I can remember, talking about the latest fund are about 150 million, and the earlier one was a bit smaller, right?
Yeah, the first one was 150, 120, followed by 150, and the actual one is 200.
200. So it's growing. And again, there is a saying in the world of venture capital that says that if you are good, you do it again. If you are not good, at a certain point after the first time, you're still there trying to sell the stuff that you are inside. So meaning that if Robert Bosch did it 4 times, means that there is a value. Obviously, one might argue that having a single internal LP like Robert Bosch make probably your life a bit easier compared to a VC fund that is on the market, but still, I think there's a lot of validation point in the job that you've done. And the question here is, this is the $1 million, actually the $1 billion question. 1 million is too small. Question is talking about a corporate venture capital fund is what's the balance between being strategic and being financial? You say something that we are really strongly return focused, but how do you balance the two of them?
No matter what you are doing, also within a large corporation, if on the long term you're not profitable, you will have problems. You can argue with innovations and something. Maybe this will help for a while, but at the end, it's good to bring more money back than invested. Yeah, that's the precondition, clear. But again, our core idea of this, and this is still the case, is to access the innovation. So I would say the innovation target or the mission to access the innovation is a little bit higher than the financial return target. Yeah, and I would say this is I mean the financial return, as I said, is an enabler We have always a balance between strategic targets and financial targets. But this is a different level. Yeah, maybe we are talking also about different time frames. Maybe that's an important.
Yeah, exactly. That is the other typical question: is what about horizons?
Exactly.
1, 2, or 3.
The venture business is always a long-term business. If I set up a venture fund, usually, and most institutional funds do it in a way to target 10 years fund lifetime, maybe 3-4 years investment time, follow-up investment, holding, and exit. So venture is a very long-term thing, whereas the strategic targets, we are looking for the latest and greatest innovation this year, maybe next year, and we will start with a product in 3 years, but not in 10 years. There is no target of 10 years, which could be argued by our strategic targets. Therefore, it's really a bit different, and we also learned over the time that we have to differentiate between investment and deal flow. And investment and innovation could be in line, but is not necessarily. It's also one of the reasons that we have, since existing of RBVC, never exited a company to Bosch.
Yes, that's another point.
If we do see a good deal, then it's a good venture deal. But we do see about 100 times more companies in our deal flow. And maybe 10 times more companies, or even 15 times more companies out of the deal flow are relevant for innovation despite the investment. That's a relation. So again, this is an enabler. It could fit. Some of our companies do really fit. We have nice cooperation with the headquarter and the Bosch business units, but this is not precondition. But the innovation power is much, much higher than investment. I think this is the key. And investment, once you are committed, like marriage, once you are committed, even though the LP's strategy is changing, you have to act according to the startup interest over time. If you do not do that, first of all, you have legal problems. And secondly, you have reputational problems in the markets. And this is something I observed in the last years is also changing. So the first venture funds, corporate venture funds, purely invested on a strategic base. And I can assure you, this doesn't work at all. If your investment is based on strategics only, you can be sure that either the startup strategy is changing in 3 years, or the corporate strategy is changing. And in most of the cases, it doesn't fit together after a while. Therefore, most of the corporate funds entirely betting on strategy investments failed entirely and disappeared. And the funds who separated innovation and investment, they are still in business. It's, I think, the key learning we have done over the years, and we had some iterations also in that area.
Question here that I think is super relevant. You have a CVC that is instrumental to the innovation of the group, Bosch. The question here is, having a CVC is needed to feed the parent company, or your company, with high quality prospects, or you can have like some other corporates are having a pure venture client model, meaning I do not invest, I don't want, actually it's not my job, I just want to source the best innovation and bring them in and start working with them. How much can add having a CVC, and or is a unnecessary cost, an unnecessary burden that?
Yeah, so a pure venture client model might work for a while. I think it's better than nothing. Yeah, but you will always come to a point where you have to assess the companies, because you don't want to do venture client with any company. It's not about startup collaboration itself, it's about the innovation. So you need the best companies and you need the best innovation sources. And somehow you need a tool to assess, is this a good one or is this a bad one? And if you have fantastic teams in the units, I think part of that could be assessed, yeah, also by the business units. But if the investors network is missing and you just pick up your phone and call the other investors, do you have any experience? Or you check the older databases. Yeah, most of the companies we are cooperating with, we know since years, so we have a little history. So if you're not able to assess the insights, maybe there is a risk that you do not find the best companies always. Yeah, I mean, we also fail sometimes, yeah, and then it's a nice try and we stop the venture client model. But our success rate was surprisingly high because of upfront filtering. And there's always a lot of capacity involved also in the units. If you start a cooperation with a startup, it's not that they just show a demo or something. Usually you also have to invest time, money, capacity in these corporations. And that is risky if you bet on the wrong horse too early. And therefore I thought it's a good mix to have the venture model and the venture client in close cooperation. Yeah, but venture client is super. So I'm really convinced it's a good idea. It's the easiest way of a collaboration, and it is a good starting point for anybody.
So if I can elaborate your point, tell me if I got it right. Yes, the venture client model might work standalone, but having a CVC on the side that, by the way, has a strong financial requirement. You substantially have something that is self-funded, because again, if you have a good CVC arm, that will not waste money, but at the end will produce money. And by the way, you have also access to a larger, more qualified deal flow.
Yeah.
Then the deal flow, part of them will be exploited by the CVC fund, adopting a pure investment approach. That's, by the way, the job that you guys are doing. And part of the portfolio company might start working even better, more integrated with the group, or somehow part of the deal flow that probably is not interesting for an investment purpose might still be contribute to the deal flow of the venture client. So that might be probably...
Absolutely. And it is also interesting for us to get proof points from the units. So if we're doing a proof of concept with a company and we do see, wow, this is a real good result, unexpected and extraordinary, it's much more likely that we put an investment in that company. Yeah. For us, it's also a tool to assess technologies of the companies, and that's what we have done from the very beginning. But as I said in the beginning, we do this now more systematically. Yeah, and the core secret in that is standardization. Yeah, the better you standardize your process, the more efficient it is. And this is required because of the sheer mass of startup companies coming up every year. Yeah, there are so many. If you don't have a standardized process and kill cooperation early, you are immediately dead. Yeah, but I better one more point, which is probably interesting or valuable, is the international footprint. So whatever technology or company we are discussing in our venture unit, we always check at least North America, China, Israel, Europe. are there comparable companies visible? Yeah, and if you have only a venture client model without these regional checks, you might end up with cooperating with local companies only, which could be good. Yeah, why not? And you miss the best one. And this is difficult. Then you restart from the very beginning, and then you lose traction.
No, that point I totally agree. Yeah. Actually, most of our customer, we support them in scouting. We exactly do that. We expand the scouting at global level because, unfortunately, but also if you are sitting in Silicon Valley, probably is the richest pool that you might fish. Still, you need to check around. And today, there are a lot of growing ecosystem. The one that you mentioned are relevant, but there are other ones that are coming out, and you need to, at a certain point, also when we find a suitable solution, we need to start looking for comparables and see if something better around that. Obviously, strategically speaking, not all of them might be contendable and accessible, but still, this is another discussion. But I totally agree with you. That's definitely the point. I think it might be valuable to explore a bit more the Open Bosch context. Again, this is a new, I'd say, an emerging trend, quite recent, despite it's not super novel. There are other CVC that have started profiles, internal profiles called implementation manager, partnership managers. I think Shell Ventures have them, Suez Capital have them, other corporates are, other CVC are having profile like the one that substantially Open Bosch is doing. And I think discussing with some of these other CVC, one of the reasons is, yes, we have a beautiful deal flow, but on the one hand, this deal flow, despite it's technically accessible to the parent company doesn't have the time, the way to tap into. And on the other hand, we have fantastic portfolio companies, and these portfolio companies are substantially sometimes might exploit the advantage to having a large corporate behind us, but at the end are not doing it or have difficulties in exploiting these events. What is the perspective and the reason behind Open Bosch?
Yeah, if we are looking to the external innovation, we try two basic ways. So one is push principle, and the other one is pull. So push principle, if we do see highly relevant, interesting companies in the startup landscape, we would trigger these companies to the business units and try to start a collaboration. Probably this is similar to our portfolio companies, since they are very tightly managed by us. We would ask the relevant units to cooperate, and in most cases it works. That's one angle. The other angle is more the pull principle. Yeah, and I mean, we are still trying out different things, but pull principle means the unit, the operational market responsible unit, is formulating a specific problem. Yeah, we would like to improve quality of this and this process, machine interaction, whatever. And the more concrete this problem definition is, the better we can start looking for potential innovation partners. What we figured out is that the pull principle leads to more sustainable partnerships at the end. Yeah, and certainly we have also partnership management responsible persons. We have persons organizing the proof of concept projects. These are, as I said, very standardized things. And at the end, our target is to have such a high awareness in the organization to recognize external innovation as a important part of the overall innovation process. This is the overall target. I mean, there are a lot of great internal innovations, and we have a fantastic access to many experts. This is good for us because then we can access new technologies or new companies quickly. But at the end, you need to solve a problem. You need to improve the competitiveness. You need to improve the innovation leadership. Yeah, and I think at the end it's more a pull, which leads to a way to achieve this target. Yeah.
Yeah, the problem of the pool model, at least that is another problem that the venture client faces, depends a lot, as you said, on the maturity of the business unit and the culture of the company, because sometimes the ability to recognize the need, if you are not exposed to some potential solution, some potential direction, is definitely harder. I think what again, sometimes I'm asked, what's different between scouting and the regular procurement process? You have a need, you go out, you look for a solution that might be an SME or startup is the same, and at the end, but the problem, at least what we see, is that sometimes you have a need, and then the need is at the beginning is quite unclear, and then the more solution you get exposed, the more you qualify the need, and sometimes looking at a specific solution, you perceive that you have a need that might be exploited by some of them. That's the process that is really difficult to be directed from one side or the other.
I think most of our people are quite open for this external cooperation, and most are really interested in doing that. Often barriers are more on a practical way. How to issue a contract? What form of collaboration is the best one? How can I start this? Where do I get the first 5,000 euro money from? Whom do I have to ask? These practical approaches, these are sometimes a higher barrier than the actual implementation later. And therefore, I said, as soon as we reach a point where standardization is so crystal clear for everybody, and it's easy to start a collaboration, without asking lawyers to negotiate IP contracts over 6 months, and then you lost the innovation already.
Yes.
And another important point is also the timing. We talked about seed deals in the very beginning. Seed deals are interesting for venture, especially for venture companies specialized on early stage investments. However, for corporates, it's sometimes not that easy to digest seed deals because the majority of the product is too early. People need good working products, software packages, whatever, and really released, tested, and ready to use. That is something which shifts more to later stage companies in terms of collaboration than investment. Therefore, you have to balance. Is it an investment? It's rather earlier stage, and we see if we can do a collaboration later, or we directly go into later stage investment and immediately start to cooperate. The timing is decisive. If you are too early, it is same damage as if you are too late. And also the developing process has only a small time window where you can digest external innovation. If we are talking about product innovation, there is a very small window, and then decision is done. Okay, we go in that direction, project is defined, and we go into production or in sales. That's an important thing. The right time.
No, is a critical point that you just made, and actually the venture client, when it works well, it typically addresses late stage startups, what we call scale-ups, because early stage startups are the best fit for business units, typically speaking. The point here, and the question that I have for you is, what we are seeing, at least looking at the data from the CVC across the globe, that typically CVC are not investing early stage either. Most of them are mostly looking for quite substantial, if not super late stage, but quite substantial late stage solutions. So also having a CVC and a venture client model, there is still the big question on the table: how do you address as a company early stage solutions? Accelerators, venture builders, startup studios. What else? What's the Bosch approach to deal with that?
Yeah, we have a couple of startup collaboration spaces, not only organized by us, but also by various business units in the regions, in China, in the US, in Chicago. We have a open startup space. So that is for sure one key activity in this early stage innovation. We from venture side, we sometimes do also early stage investments. Yeah, but this is rather a mechanic out of the fund size. Yeah, if you have a specific fund size, yeah, like we have with currently 200, then you cannot invest too much time into greedy deals with 100K, 500K. The team is simply not big enough to handle all this. Yeah, so we specialized rather on later, a bit later stage. Series A, Series B is our sweet spot, I would say.
And which is the percentage for a fund of 200 million? How much you can allocate on early stage?
Very tiny. We can do maybe 10 million in the overall fund in early stage.
So
to give you about
5%. The problem is not the number of the investment number of the portfolio company that you need to follow up, and then that's this becoming
exactly. Once you have a specific portfolio size, you will recognize that this is a lot of work for follow-up. Yeah, there are board meetings, there are documents, there are follow-up financing, there are extraordinary things, and suddenly you have to review a lot of things permanently, we have almost done 85 investments, and still we have about 60 active portfolio companies. This is something to manage. Yeah, but this is typical venture capital business. So therefore we are not in the area of a spray and pray investment, where we are doing a lot of things. We really try to concentrate on a little bit bigger tickets.
Also because the spray and pray investment model is still, I believe, proved to be successful, because again, if you look at also at the typical spray and pray investor, there are the accelerators. I think if you look at the performance of most of them are quite dubious, and so that is a model that is very, very complicated to extract value, and I think you need to have a value chain or later stage funding to follow up the good shots that you were able to get in order to be able to monetize what you out of your work.
Exactly, it's a different business, so I'm not sure if this is more or less successful, but it's totally different space.
Yes. Yeah. Okay, I will spend my entire day talking to you, Ingo, as usual, but I think we are coming to the end of our discussion. Final question. What are the next plans for Robert Bosch Venture Capital, yourself? What's your up to in terms of new things?
Yeah, we have one bigger adventure in mind. We would like to go external in parallel to our internal funds. We have a target to raise external money in China. We set up already an organization years ago in China. We are investing out of our global fund in China, but China itself is so relevant for RBVC and for the Bosch activities that we looked for a way to increase our impact. Therefore, we have started an activity there, and I hope in one of our next meetings in next year I could announce something. Yeah, but definitely we would look in parallel also to raise external fund. Yeah,
I think that's maybe quite another forward-looking move for a CVC, and I think this is just my opinion, is a move that you can do based on the track record that you're able to have in the prior investment cycle.
Certainly, we hope that we can build, or we are sure that we can build on our track record. I mean, everybody can watch the performance of our portfolio companies, and this helps a lot to convince external LPs. We will close the fund in the next months already, so it's not just a plan; it's relative concrete, and we will start investment next year out of this fund in parallel to our fund, which hopefully increases our leverage in that so important market for us. That's one of our future ideas. The other idea is to scale with our Open Bosch activities, to scale business impact, to scale POCs, and we have some challenging targets defined for next year. And this is very concrete, and we have a lot of support, especially by our CEO, Michael Bolle, which you met already, I guess, in another interview. Yeah, we are getting an open company, open towards innovation, and we try to help to realize that.
Very, very exciting. I think all the best for your future endeavors. I'm pretty sure that will be successful as everything you have done so far, at least based on my perception, that is very good. And so again, thank you for spending some time with us, and looking forward to talking to you next time.
And thank you very much for the awards, and thanks to our teams in Bosch as well as in Robert Bosch Venture Capital. Thank you very much.
I think it was well deserved. Bye, Ingo.
Thanks, Alberto. Bye.